Good morning, everyone. You're watching live market outlook for Tuesday, 31st of January 2012, prepared by Windsor Brokers. Last day of the month shows that some positive sentiment is back in play in the markets after initial reversal that occurred yesterday on the most of the instruments that were appreciating in past couple of weeks, as euro regains strength again on some positive tones coming again from Eurozone. Basically, the Europe signed yesterday the German-led fiscal pact with the positive tones also coming from Greece as their negotiations with the private bondholders are approaching the end, and according to the Greek Prime Minister, there is quite likely that the deal will be closed within the next few days. This gives the boost and positive tone to the single currency, while dollar registers fresh lows across the board. Especially significant loss was against Swiss franc, where when this greenback reached fresh lows last seen a couple of months ago. Gold is heading higher and approaching its our targets at 1750-60 zone, while crude oil is also supported by concerns about Iran, as the problem persists and still in the rhetoric form, but quite a big possibility of escalating into something more bad, let's say. As mentioned yesterday, the Eurozone on yesterday's Eurozone meeting, the treaty was the pact was signed by 20. Apologies for interruption. There was a technical problem. The German Chancellor Angela Merkel has cemented her political ascendancy in Europe yesterday, when 25 out of 27 EU states agreed to a German-inspired pact for a stricter budget discipline, even as they struggled to rekindle growth from the ashes of austerity. Only Britain and the Czech Republic refused to sign a fiscal compact in March that will impose quasi-automatic sanctions on countries that breach European Union budget deficit limits, and will enshrine balances budget rules in the national law. The accord was eagerly greeted by European Central Bank, which has long pressed Eurozone governments to put their houses in order. Officially, the half-day summit focused on a strategy to revive growth and create jobs at a time when governments across Europe are having to cut public spending and raise taxes to tackle mountains of debt. But differences over the limits of austerity and Greece's unfinished debt restructuring negotiations hampered efforts to convey a more optimistic message that Europe is getting on top of its debt crisis. Merkel told in a news conference the agreements on the fiscal pact and the permanent rescue fund for the Eurozone were a small but fine step on the path to restoring confidence. French President Nicolas Sarkozy said he expected a deal on reducing Greece's debt to private bondholders within days, and he believed independent European institutions a clear reference to the ECB would help meet the funding gap. Greek Prime Minister Lucas Papadimos said he hoped to reach a deal both with private creditors over restructuring 200 billion euros of debt and on conditions tied to a second bailout by its international lenders by the end of this week. Until there is a deal, EU leaders cannot move forward with the second 130 billion euro rescue program for Athens, which they originally pledged at the summit last October. Without it, Athens faces default in March when huge bond repayments fall due. The EU leaders also agreed that 500 billion euro European Stability Mechanism will enter into force in July, a year earlier than planned, to back heavily indebted states. Europe is also under pressure from United States, China, and the IMF and some of its own members to increase the size of financial firewall, but Merkel has refused to consider the issue before March. Just highlights also for the overnight session that the euro is firming from yesterday's dip, as well as sterling, while Swiss franc hovers near a 4-month peak against dollar and euro, and the most significant is yesterday's fall towards 120 on euro Swiss. That might be trigger for the Swiss National Bank to react and intervene again like it did last time, as they lifted peg at 120 on euro Swiss. Also, there is a risk of intervention of Bank of Japan as yen is further strengthening, and yesterday it lost its key medium-term support zone at 76.50. Currently hovering just above next mark at 76, ahead of historical low of dollar yen at 75.56. That was posted end of October 2011. Gold, as I said, is heading higher, currently at 1740 zone, while crude oil is regaining some ground after dipping to the levels at 98.40 zone, regaining 99 barrier, and currently heading towards the next barrier and psychological resistance at $100 per barrel. A brief look at today's calendar that is quite full. Already released from Japan a number of figures. Unemployment rate in Japan rose to 4.6% compared to 4.5 forecast and the previous release, while industrial production monthly is up by 4% compared to 2.8% consensus for today, and the negative figure of the previous month release at minus 2.7%. From Japan, also housing start came in a quite negative figure, 7.3, minus 7.3, pardon, is today's release versus the forecast of minus 1.4 and the previous month release of minus 0.3%. This is the on a yearly basis. German retail sales also came in negative this morning. Monthly release minus 1.4% compared to the forecast of 0.9% and the previous month figure of minus 1%. Still to come, net lending to individuals from UK, 1.2 billion pounds is the forecast for today compared to 1 billion of the previous month. Mortgage approvals are expected from UK also are expected slightly to increase to 54,000 compared to 53,000 the previous month release. Eurozone's unemployment rate due at 10 o'clock GMT increase to 10.4%. Unemployment rate is expected for today compared to 10.3 of the previous month. Across the ocean, Canadian GDP monthly release is expected to raise by 0.2% compared to 0.0 unchanged the previous month release. From US, employment cost index quarterly release 0.4% consensus for today versus 0.3% of the previous month release. And at 14:45 GMT, Chicago PMI forecast for today 63.1 compared to 62.5 of the previous month release. That was from today's calendar. Now, quick look of the market movements in past 24 hours to see what are the expectations for today. As we can see, euro, after hitting 132.32 high on last Friday, end of the day, made a significant correction lower, dipping down to 130.75. This is the previous lows of last Friday, and also 50% Fibonacci retracement of the up leg from 129.30 to 132.32, where the dips were contained so far, and subsequent bounce regained the 131, extending close to 132 barrier that stays intact for now. 131.96 high was seen so far ahead of current easing. That was on overbought hourly conditions. Immediate outlook maintains a bearish tone of 130.75, with the focus still higher as long as 20 days moving average currently at 131.46 holds the downside and keeps the latest up leg from 130.75 in play. Retest of 132.32 to open way for a further extension higher, as this marks also 38.2 Fibonacci retracement of the broader downtrend from 142.46 to 126.22. 133 as a figure resistance comes next, ahead of 90 days moving average, currently standing at 133.36, seen as the next technical barrier. On the downside, as mentioned, dynamic support at 131.46 and 131 figure support. However, loss of 130.75, 130.60 would be risky. There is also the main bull trend line currently at around 113.90, loss of which might risk deeper reversal and put immediate bulls on hold in favor of deeper reversal. On the downside, 61.8 Fibonacci retracement of the latest up leg from 129.30 stands at 130.46. That would be the next target, while loss of 130 would risk a test of 129.30 zone low of 25th of January. The cable is again back to strength after initial hesitation. Actually, the pair was unable to clear 157.40 previous high that in the second attempt it failed, and the subsequent reversal found ground for now at 156.50. This is initial support zone and the current near-term range floor. A brief extension above was seen this morning at 157.53, likely to open way for test of critical barrier at 157.70. This is December's congestion range ceiling, above which to signal a fresh bull phase, and open initially 61.8 Fibonacci level at 158, ahead of possible test of 159.00, the figure resistance, and 159.58, where the 200 days moving average currently stands. On the downside, 157 zone offers now initial support as a figure support, as well as 20 days moving average that maintains the recent rally from 156.50 zone, and the loss of which would soften. However, the main support now lays at 156.50.40, where is also the main bull trend line drawn of 152.33 low of 13th of January, and the break below this support zone might delay immediate bulls and open way for a deeper reversal. 155 and 155.30 remains as a key support, and break here to signal an end of the short-term bull phase. For now, the studies are quite positive, and especially on the daily one, where currently 90 days moving average contains the dips and keeps the upside supported, with studies well above their midline suggesting a further extension higher and possible test of critical resistance at 157.70. Dollar yen continues to spiral lower after unsuccessful attempt to clear strong resistance at 78 2030 zone, also to 200 days moving average, where the recent gains were capped and the subsequent sharp reversal lost initial and strong support at 76.50, the level that kept the downside protected for past 2.5 months. Levels close to 76.00 were tested so far, 76.16 seen in early hours this morning, with the 20 days moving average on hourly chart clearly maintaining the recent downtrend in past 4 days. It's continuously capping the upside, with this morning's brief attempt higher being held below 76.33-35, where the currently moving average stands. However, any recovery attempts would still be seen as corrective. 76.50 previous strong support now acts as strong resistance, and 76.75 are expected to cap the upside. There is also descending 20 days moving average on the 4-hour chart at 76.86 that will likely limit corrective attempts. High risk of Bank of Japan's intervention persists, as their officials already announced that too strong yen as it is now, and for further with prospect for further strengthening of the Japanese currency, it's not suitable for them. So all cards are on the table open, and possibility of intervention of Bank of Japan is quite high. Just reminder, they intervened last time at on 31st of October, when the pair dipped below 76 and posted fresh record low at 75.56. Dollar Swiss came under pressure again in the near term price action after hitting a fresh low at 91.13 last Friday, with recovery attempt being capped by 20 days moving average at 92.08, just ahead of initial barrier at 92.27 last Friday's high. Further easing now still holds above 91.16 at 91.38. The ground was found. However, pressure remains to the downside, as the hourly and 4-hour studies are still in the negative field, and the likely scenario would be extension of the broader downtrend from 95.73, double top of 16th and 13th of January, with the break below 91.16 and 91.00 to expose Fibonacci level 90 to open the first 90.46, pardon, 90.75, the 50% Fibonacci retracement of 85.66 to 95.33, ahead of 90.00 as figure support, and 89.55, 61.8% Fibonacci retracement. The daily studies are now turning into negative field, as we can see that MACD already broke below the center line, and suggesting further easing of the pair of the broader uptrend from 70.67 to 95.93, as 90 days moving average currently at 91.83, capping near-term corrective attempts. So the near-term outlook sees more possibility of further extension lower. Now everything depends also on the Greece, that is the focus of this week. with the likely scenario of finding a solution at this time and avoiding immediate default would be quite supportive for a single currency and quite negative for the US dollar at this point. This might also trigger further weakness of dollar Swiss, but a possibility that I mentioned earlier of intervention of Swiss National Bank as Euro Swiss approaches critical support at 120 is also pending, and the possible action of Swiss National Bank will also affect, along with the Euro Swiss, will affect the dollar Swiss and likely push the dollar higher. Gold remains in the steady uptrend from 1522 low of 29th of December. We see that the pair surged through the daily Ichimoku cloud and currently heading towards our initial targets at 1756 and 1763. A break above main bear trend line and 55 and 90 days moving averages keeps the upside focus as studies are in the positive field on the daily chart. On the narrower time frames, also positive tone persists with the 20 days moving average on 4-hour chart currently at around 1725, maintaining the recent rally. Hourly studies are also positive, and we see that this morning's price action shows the pair heading higher and approaching initial resistance, at 1756. Static supports at 1716 and 1700 are expected to contain any corrective action as hourly conditions are already overbought. How yet no signal of reversal, but suggestion that suggests that the gold might be undergoing short corrective action before resuming the broader bullish tone. A break above 1756 and 1762, which is also close to 61.8 Fibonacci retracement at 1767 of 1920 to 1522, would open the next pair of resistances at 1796 and 1802. Actually, it will open a psychological barrier at 1800. Current situation in the world, especially with the European debt crisis, still, I would say, quite away from the stable solution, and raising tensions in the region of close to Iran are keeping investors back into gold as a safe haven instrument. The crude oil is near-term action is still positive as the price found support at 98.42 yesterday, with the latest reasons, fundamentals, news that coming out from Iran and Sudan being supportive for the oil price. Break above near-term triangle is currently heading towards 100 barrier as a psychological barrier ahead of 161 high of 27th of January, and most significant level at 101.37 posted on 26th of January. This would open way for a further recovery with initial support at 98.42 expected to stay intact in order to support. On the broader picture, we can see that the crude oil price is basically within a consolidation range after hitting a fresh high at 103.72 on the 5th of January, with the tone still skewed towards the downside, but the downside remains supported for now at 97.40-50 zone, and only loss of this level would be risky for further easing, as the upside is for now capped at 103.72. The weakening daily studies might risk further Reversal, however, regain of 55 days moving average today would look for a test of 100 and then 100.53 where 20 days moving average stand, and this is required to confirm. Above this 101.57, 101.37 and 101.57, the main bear trend line drawn of 103.72 are coming as next barriers. On the downside, as I said, only loss of 97.43 would risk further easing towards a 95 zone, and a very strong support at 92.70 low of 16th of December 2011.